Hello and welcome back to the Wall Street Petting Zoo podcast, your source for market news. I'm Christopher Smith.
And I'm Robert Coburn.
This is our This Week at the Zoo segment in which we review the previous week's news, review our stock picks from last week, and offer you some stock picks for the upcoming week. And this week on Monday, we started off the S&P 500 and NASDAQ indexes both reached new all-time highs, driven by strong earnings, optimism about China trade talks, and high expectation of a Fed rate cut. We also had some pretty strong earnings results, especially from pharmaceutical companies, including Merck, Pfizer, and Amgen. We've been trading in a range recently, Robert, sort of stuck underneath a certain level where the market had maxed out. And so to break above that level signals sort of a new market condition. So it really seems like the market could move ahead now in a way that it didn't have the green light to do before.
Yeah, it seems like a lot of analysts are getting confused as to what's going on, because it just seems like the macroeconomics that's been taught in school just seem to be going out the window, especially with the jobs report that came out Friday.
Yeah, it's true. The market does seem strange to be at new highs when earnings year over year are down. But I will tell you one thing that's going on, Robert, is there's a seasonal factor. Um, it's always been the case that in November the market picks up and it stays strong for about 6 months, and then investors exit during the summer and early autumn. So right now, with heading into November, all those seasonal investors are coming back. And so that's one thing that's going on, is that we're just seeing the return of seasonal investors who exited the market several months ago.
I thought it was just because of Christmas.
It's probably, there's some of that too, I'm sure. But, earnings have been better than anybody expected. So partly it's just that expectations have been so low that they're easy to beat. And so it makes the earnings results and the economy probably look better than it actually is. Just
Set a
because the
low bar.
expectations have been so low. Yeah, exactly.
So Tuesday and Wednesday morning, the market pulled back a bit as investors awaited the Fed's interest rate decision, which the Fed did decide to go through on Wednesday. Wednesday morning, we got an oil inventory report from the EIA, which showed that oil inventories had increased almost 8 times more than analysts expected, so oil prices fell. We also got a GDP report Wednesday morning that showed GDP growth had slowed to about 1.9%, which is well under the 3.2% growth rate assumed in the Trump administration's budget.
Yeah, and then Wednesday afternoon, the Fed announced its third interest rate cut of the year. Um, Definitely that early morning GDP report that showed that GDP growth had slowed. Surprisingly, that's actually a good sign for stocks, because what investors have been looking for is reasons for the Fed to cut interest rates. And so really the slowing economy has caused the Fed to cut interest rates. And I think that's a major reason why the economy is surging ahead, because lower interest rates means more people are going to borrow money and invest it back into the economy and buy products and so forth. So stocks should perform pretty well. Usually in the 6 months after a third sequential rate cut, um, stocks do pretty well. However, the Fed also signaled when it made this interest rate cut that it may not cut them again for a while. It's going to pause, going to hit pause on the rate cutting cycle. And so as a result, after this announcement, stocks, gold, and oil all initially pulled back, which is something that happens when the Fed does this. The market, at least in its initial reaction, seems to weigh like future rate cuts more heavily than the immediate rate cut. And so this is something that I sort of expected. This is something that often happens when the Fed announces a rate cut, is that they'll say, well, we're not sure that we're going to cut rates again this year. And then the market pulls back for a day or two. But then, of course, you get after the initial sort of negative reaction, you get the market moving higher. And we definitely saw that this week. So it pulled back for a day or two on the news that they weren't going to cut rates again. But we're moving ahead again, and we got kind of a nice rally in gold and oil toward the end of the week here, and small caps, gold, and oil all tend to perform really, really well in the 6 months after a rate cut. So I think that those are all fairly good investments right now.
Now, do those stack since we just got like two rate cuts in like the span of like a month?
Yeah, they should. So here's the thing, like gold and oil in particular tend to do they tend to go opposite the dollar. And the dollar should be weakened by rate cuts and also by the QE that the Fed is doing, where basically the Fed is printing a lot of money right now in order to add liquidity to lending markets. So there's a lot of reasons for the dollar to weaken. But surprisingly, this year we haven't really seen the dollar weakening. We've seen the dollar remain in an uptrend. And so there's a lot of analysts out there saying basically the Fed has lost control over inflation and the Fed can no longer maintain inflation within its target. We've been under target for inflation for several years now. The target is 2%, and we've been in like the 1.5 or under range for inflation. So if the Fed can succeed in achieving its inflation target and weakening the dollar, then gold, oil should both do really, really well as we return to sort of target inflation rate. But if it turns out that these analysts are right, that the Fed has basically lost control of inflation rates and the dollar remains in an uptrend, then gold and oil will sort of return to their fall. So I think at least initially we're going to get a nice rally in gold and oil, but the long term perspective on gold and oil really depends upon how effective the Fed's policies are at achieving that 2% inflation target, whether these interest rates actually do what the Fed wants them to do. As far as small caps, it's three sequential rate cuts that makes small caps usually perform a lot better than large caps. So I don't actually know how they would perform with like one or two rate cuts, but third time's the charm as far as small caps go.
That's because it makes it easier for the smaller companies to take out loans, right?
Yeah, I think so. I think so. One of the major risks for small caps is that they have a lot of debt typically, and if they were to have some major shock like a lawsuit or something like that, it could make that debt really hard to pay off. It could lead to bankruptcy even. So when there's low interest rates, it makes them like much easier to refinance. Just it makes it easier to get financing, get funding, and also to restructure their debt in a way that's more advantageous for them. So yeah, I think that that's part of what's going on there.
So Thursday, amid news reports that Chinese officials have their doubts about a long-term trade deal with the U.S. being made, the Dow, S&P 500, and Nasdaq all fell. Right before Friday, where we got a jobs report that showed the economy added about twice as many jobs expected last month, although that's not with the manufacturing sector is still suffering. So having lost about 36,000 jobs in the manufacturing sector. So that's not a good sign. Stocks moved higher, partly on the strong jobs number and partly due to the interest rate cut earlier in the week.
Yeah, we definitely are seeing a lot of problems in manufacturing. We're still seeing the trade deficit grow. And of course, bad manufacturing sector is bad for material sector. So steel and other materials, chemicals companies and so forth are definitely going through a hard time still. So as long as you're in the right sectors, you can do pretty well right now. But I think there's still a lot of risk in those manufacturing and materials kinds of companies.
Which is funny because steel's actually up at the end of the week. It's up. It jumped 13% on Friday.
Interesting. I mean, rate cuts tend to do that to metals because metals, well, it's true of gold, but it's really true of all metals that to some extent they move opposite the dollar. So that may be, partly speculators and investors buying up steel. But I still think the long-term macroeconomic picture for things like steel and chemicals are pretty bad. So I actually was looking at U.S. Steel this week. I originally had it on my list of stock picks. because it is showing some strength right now, and the rate cut should be at least temporarily good for it. But when I saw these manufacturing numbers, manufacturing sector having lost 36,000 jobs and still haven't seen any progress on a trade deal, it kind of seems like we might be headed toward sort of a permanent trade war with China. That makes me think that the long-term picture for the metals companies may still be fairly bad. So
Wouldn't a non-trade deal with China be better for steel, like U.S. steel?
I mean, so the theory, right, of tariffs is that it's supposed to help the U.S. manufacturing sector. That was Trump's original goal, but that's certainly not how it's worked out. It's been really bad for U.S. manufacturing, actually. So
Yeah, because a lot of the piecemeal parts that come out of manufacturing come out of China, right?
Yeah, the manufacturing sector here is definitely using China supply chains. So that's part of the problem. It's driving up the cost of American products because they can't get materials from China. But also, China has been a major export market for the US. So we're not selling as many products in China as we used to because China has retaliated against our tariffs by imposing tariffs of their own. So we've lost a major market for U.S. goods, and so that really is the key right there.
Yeah, I think that was what was going on with like the soybean market. Like we used to export like millions of pounds of soybean to China, and then now all these soybean farmers are sitting on like a mountain of soybeans that are about to expire because China's not buying them.
Right, right. And pork is another one. Apparently, pork, all the food banks around the U.S. are filling up with pork that we can't sell to China anymore.
I'm sure there's a lot of bacon lovers out there.
Yeah, certain sectors have definitely been hard hit by the trade war thing, and I think that for the foreseeable future, that's going to continue. But we will see an uptick in some of these metals companies as a result of the rate cut, I think. All right, so let's give an update on the stocks that we've been watching. Why don't you get us started, Robert?
All right, let's talk about the WWE and the circus. Not only over the week of uh, of their stock, but also the news out of this weekend because there's been a lot of controversy right now with WWE, especially with their. They actually have like a long-term deal with Saudi Arabia and doing shows in Saudi Arabia, which not a lot of people are very supportive, especially with the news. I think it was either earlier this year or was it late last year when that journalist got killed in Saudi Arabia.
Yeah, and they
So
say it was the crown prince who did it.
yeah. So ever since then, there's been a lot of controversy with WWE and doing their shows in Saudi Arabia. Now it's been good for their stock because Saudi money is a lot of money, and they actually beat earnings estimates by 200%. Uh, but their third quarter profit dropped down to 6 million compared to what was 30 million in profit last year's third quarter. I think you also had something to add for this.
Yeah, so even though their profit beat estimates by 200%, their revenue actually missed estimates by about 2.5%. And they also reduced their profit forecast for next quarter, came in about 15% under analyst estimates, which is huge. I think we've talked on the podcast before about how guidance really matters more than the immediate earnings, right? Next quarter's earnings matter more than last quarter's earnings because the market is more forward looking than backward looking. So for them to reduce their profit guidance for next quarter definitely hurt the stock this week.
Yeah.
And that mostly is being caused by delays around a deal with Saudi Arabia. There's some questions on whether the deal with Saudi Arabia to renew WWE's contracts there could completely fall through. And WWE also has some uncertainty around network renewals in a few other countries. So if those issues were to get resolved, the stock could definitely go back up. But there's a lot of risk here if those deals should fall through.
Yeah, and there's actually been there was some news out of this weekend where they actually had a show on Friday in Saudi Arabia, which was our Friday morning. I think it was either their late Friday evening or early Saturday, or no, it was Thursday. Sorry. Uh, so a bunch of wrestlers, I guess, or entertainers got stuck in Saudi Arabia. Uh, Supposedly, it was supposed to be mechanical issues with the plane that was supposed to carry about 200 personnel, WWE personnel, and it got to the point where the reports are the plane was on the tarmac for 6 hours. Which, if anyone's been stuck on a tarmac for more than an hour, you know how much of a pain that is. Uh, so there's been a lot of speculation as to there's maybe some distrust between the head of WWE and the Crown Prince. So this may cause the stock to be very volatile in the next month or so as more news comes out as to what's going on. Because some reports are even looking at maybe WWE's looking at canceling their long-term deal, which could have huge financial implications on the stock. So earlier I was assuming that since their quarterly reports, their stock was down so low that may actually bounce up. But now with these news reports on what's going on with the Saudi Arabia deal, it could actually go even further down. So this definitely stock to watch in terms of if you own stock, it may be a good time to at least sell off, maybe or sit and hold and wait if you're optimistic and hope that everything works itself out. But definitely, I don't think it's a good time to buy right now.
Yeah, I agree. I think that there probably will be a buying opportunity coming up sometime in the next year, but there's just so much risk here. I would want to see a few of these issues get resolved before I chose to enter.
And then in lighter news, Apple and Facebook both posted gains about 3% by the end of the week, and then GE reported earnings Wednesday morning. Although they fell short of expected revenue, they increased their free cash flow, which caused the stock to surge up like 15%. And GE is actually one of my long-term stocks.
Oh, nice. Very nice. Yeah, I actually got in a few days before the earnings report and gained about 8%. Sold in the morning after the earnings report for an 8% profit. And the reason that I did that was because I saw that options traders were betting on GE to go up after earnings. And so if you're interested in following big options traders and using that as a strategy for investing, you can definitely go check out our educational video this week. It's our Zoo Tour segment, and it's basically titled How to Follow the Big Options Traders. So go check that out if you've got time. This week, I watched oil and gold pretty closely, especially in connection with the Fed rate cut. I made some quick money shorting oil on news of the surprise crude inventory build on Wednesday morning. And I also made some money in a gold miners ETF this week after the rate cut news. It dropped a little bit after the announcement of the rate cut, and I placed a bet that it was going to go back up, and it did. So made some nice money there. There's a gold miners ETF called JNUG. The JNUG is the ticker, the Junior Gold Miners ETF. And I think that's going to do fairly well in the next probably month or two. So not a bad time to enter that one. I'm also doing really well in Eros, which is one that we've talked about several times. It has continued its climb, and it's near 260. I'm going to aim to exit a little bit below 260 because 260 is a key resistance level for the stock. And I think that we probably will hit 260. We'll probably come back down a little bit. And then I think we could climb even higher. And I really think that this stock has a lot of upside potential for the medium to long term. This stock has been up in the $10 range before, and I think that it will probably head back up that direction sometime in the next couple of years. Okay, so stocks to watch next week. You want to kick us off for this one?
Yeah. So earnings seasons is still going strong. This week, the stocks I will be looking at this week that are reporting Tesla. Now, they report their earnings on Monday, so tomorrow, or whenever you're watching this on Monday, November 4th. So they've been recovering from a dip back in May where it reached a low of 180. The last time it was that low was back in 2016, and the stock has jumped back up, passing the 300 mark, and this is within the last 30 days. So it's jumped 100 plus points in the last 30 days. So with the earnings report, I mean, with Elon Musk at the helm, it's always been a volatile stock in terms of price variance. So I mean, this might be a stock that you want to look at, but at the same time, it's kind of hard to predict with Elon Musk and Trump not really seeing eye to eye on a lot of things, and with Elon Musk tweeting supposedly on like Ambien, which is never a good idea. Sometimes causes the stock to dip unnecessarily, but back up to it. It's not its all-time high, but it's getting back up there. Sprint reports earnings on Tuesday, and if their numbers fare better than Nokia, I think this stock may jump back up to its July highs of $8 or more. So right now it's only trading at 632, which isn't its lowest. It's not its highest, but it's kind of like in the middle. Looking back at the last year, so it's probably a good time to invest, especially right before earnings. Qualcomm has been on the rise. Basically ever since about April. They had a huge jump in April because of the litigation between Apple and Qualcomm and their patents. Qualcomm won a judge's ruling, so their stock jumped about 30 points in back in April, which is huge because the stock's only priced at 85 right now. So it jumping 30 points, which is almost close to 50%, is huge. It did dip back down in June, but it's slowly been rallying back up, back to where it was in about late April, early May. And then CVS, they report on, I think it's Wednesday, they report, and they're actually doing fairly well in terms of their stock. Now, they did buy Aetna about, I think they completed the transaction in September 2018, but then they were stuck in some litigation for that within the last year. That finally got cleared up in this past September. So when they report quarterly earnings, the stock could also jump if the numbers are right.
Yeah, Sprint and CVS are both stocks that I saw big option traders are very interested in this week. So those are great picks. I'm also watching CVS more for a long-term investment. I think that they're likely to do well on earnings this week. They've beaten analyst expectations on their last 8 earnings reports. So they definitely have a history of beating analyst expectations on earnings. So I think that they're in a good position for earnings, but also they're in a great position for sort of long-term growth. They're opening 1,500 new Health Hub stores by the end of 2021. And those are basically going to be AI-driven retail clinics that will be sort of low-cost health clinics. Could go a long way to disrupt the healthcare industry. And they've already run a pilot program in Houston, Texas, where they had, I think, 3 locations. And it was a very successful pilot test. And by the end of this year, I think they're expecting to have 50 stores open. And they're going to continue opening new stores through the end of 2021. So between that and the Aetna merger, they really have an aggressive growth plan, and they could see huge growth in the next couple of years here. And the stock is actually relatively cheap. It's been in a fairly long-term downtrend. And I think that it's poised to turn that around. I think that we could see the stock break upward out of its downtrend. Right now, it's a little more than 50% of its high from back in 2015. So it's definitely fairly attractively valued right now. I think I saw S&P Capital IQ rated it like on a scale from 0 to 100, they rated it like 96 for its valuation. So great valuation on this stock right now. They considered it very cheap. So I like CVS. Also, with the market breaking out to new highs, I think all of the indexes are great buys right now. S&P 500, the NASDAQ, the Russell 2000. I'm especially watching the Russell 2000. There's an index fund that you can use to play the Russell 2000. The ticker is IWM. It's the iShares index fund. And we already broke out above the recent high. So I think that this is going to be, a pretty good moneymaker in November. And it also looks relatively cheap compared to the S&P 500 right now. So I would be concerned a little bit about investing in the S&P 500 because I think the market has gotten a little bit ahead of itself, like we were talking about with the macroeconomic data. It just doesn't seem entirely justified for the S&P 500 to be at new highs right now. But the Russell is definitely at a more attractive valuation. And as we mentioned, small caps tend to outperform large caps after 3 rate cuts in 1 year. So I think that this is probably going to outperform the S&P 500 in the next 6 months or so. I'm also looking at the Junior Gold Miners ETF that I mentioned earlier. This has recently broken out of a downward trend line, and I think that it's got a lot of potential upside after the Fed rate cut. And in stocks, I am watching Alibaba next week. Baba blew away its earnings estimates. It also said that it expects its cloud segment to continue to grow, and its revenue increased 40% year over year, which is huge. This is a China stock, so it's a little surprising to see it doing so well amidst the trade war. But its business model is more software, and it seems to be pretty resilient against tariffs. It doesn't seem to have a lot of exposure to tariffs. So it's taken a bit of a hit because of the China trade war, but actually I think that the market is waking up to the fact that it doesn't actually have a lot of exposure to the trade war. So I think that it's going to move back up. And it's also a fairly safe investment because it's sitting on a huge pile of cash and doesn't have a lot of debt. So I expect that stock to break out upward next week. And I'm also watching Pinterest. Pinterest recorded great earnings and revenue and upgraded its earnings guidance for the year, but it dropped 16% after its earnings report. And that's basically, it's complicated, but after IPOs, there's a lock on stocks where folks who bought into the IPO can't sell for a certain amount of time. Pinterest lockup recently expired, and I think folks were waiting for the earnings report to decide whether to stay in or get out. And this is something that often happens with stocks on their first earnings report after the expiration of a lockup, is that they fall. And so I don't think that the fall was justified. I think it was just a function of the fact that that lockup had expired. So to me, this looks like a great opportunity to get in fairly cheaply on Pinterest. I think that Pinterest probably will get a run next week on the strength of its really strong earnings report. They are investing a lot in R&D and hiring a lot of people, which suggests they have a really nice, aggressive growth plan. But it also means their costs are a little high. That was the one big downside on the earnings report, was that the cost came in much higher than last year. So I do expect Pinterest to get a bounce this week, but just be aware that rising costs are definitely an issue for the company. All right, that's our episode this week. Thanks so much for hanging out with us this week at the zoo. We'll see you next week. Please make sure that you give us a like, share, or a comment on YouTube. Check us out on iTunes. We're now available on iTunes and on Podbean. If you have an Android, check us out on your favorite podcasting app. And you can also find us on Facebook and Twitter. Underneath the YouTube video, we've got links to both of those social media accounts. And we've got a referral link to Webull. If you don't already have a Webull account, Webull is a trading platform, and all you got to do is add $100 to your new account, and you get a free stock. We get a free stock. It helps support the podcast, and you get access to all of Webull's great features. They have just added options trading, so Webull is definitely on the cutting edge of trading technology and getting better every day.
We're going to have to do a zoo tour episode on option trading.
Absolutely. Let's plan on it. All right. We'll see you next week.